Hello, welcome to Capital Sensei. Today we're going on a journey through the pages of what I consider to be the 7 greatest books ever written about investing and money. This isn't just a simple book review. We're going to rank them, break down their core ideas, and extract the practical wisdom that can fundamentally change how you build wealth, starting from the ground up. Whenever we can, we answer questions in the comments, so feel free to drop your questions. Share your own favorite financial books or tell us about your investment journey. The more we share our experiences and doubts, the more we build a community where everyone can learn and grow together. All right, let's dive in. The world of finance can feel like an exclusive club with a secret language. But these books are the keys to unlocking that door. They take you from the absolute basics of financial discipline to the sophisticated mindset of the world's greatest investors. We're starting our countdown at number 7 and working our way to the undisputed champion. Coming in at number 7 is a book written nearly a century ago in 1926, but its lessons are as timeless as stone. It's The Richest Man in Babylon by George S. Clason. Now, you won't find any talk of stock charts or price-to-earnings ratios here, and that's precisely why it's the perfect starting point. This book is the foundation upon which all other financial knowledge must be built. It's not about tactics, it's about principles. The book is written as a series of simple, memorable parables set in the ancient city of Babylon. It tells the story of Arcad, a humble scribe who becomes the richest man in the city. When the king asks him to teach his secrets, Arcad boils it down to a few simple rules, or cures for a lean purse. The most famous and most powerful of these is the first cure: start thy purse to fattening. What does that mean in modern terms? It's the principle you've probably heard of: pay yourself first. Clason, through Arcad, advises that for every 10 coins you earn, you should keep at least 1 for yourself. Before you pay the grocer, the landlord, or anyone else, you set aside a portion of your income for your future. This isn't just saving what's left over at the end of the month, because for most of us, there's nothing left. It's a fundamental shift in mindset. Your savings and investments are not an expense. They are your most important bill. Think of it like this. Imagine you're building a house. You can't start putting up walls or a roof until you've laid a solid concrete foundation. Trying to invest in complex stocks without having a disciplined savings habit is like trying to build a skyscraper on a patch of sand. The Richest Man in Babylon teaches you how to mix and pour that concrete foundation. It's about building the habit of accumulating capital, which is the raw material for any investment. Another core lesson is to make your money work for you. The gold you save is just the beginning. The goal is to turn that saved gold into a stream of slaves, or income-producing assets that work day and night to earn you more gold. Each dollar you save is a potential employee. If you let it sit, it does nothing. If you put it to work in a wise investment, it starts earning you more dollars, which you can then reinvest to hire even more dollar employees. This is the essence of compounding, described in a way that feels intuitive and powerful. This book is required reading for anyone who feels like they're stuck in a financial rut, living paycheck to paycheck. It gives you the simple, actionable blueprint to break the cycle. Moving on to number 6, we have a book that takes the ancient wisdom of Babylon and gives it a modern, no-nonsense, and highly practical operating system. This is I Will Teach You to Be Rich by Ramit Sethi. If Clason gave us the 10 commandments of personal finance, Sethi gives us the software and apps to implement them in the 21st century. This book is less about philosophy and more about action. It's for people who want a step-by-step guide to setting up their finances to build wealth automatically. Ramit's central thesis is that we often get bogged down in tiny, unimportant financial decisions, like whether to buy a $3 coffee. He calls this micromanaging your finances. He argues that you should instead focus on getting the 5 to 10 big wins right. These are things like negotiating your salary, automating your investments, and choosing the right bank accounts. If you nail these big decisions, you can afford to spend extravagantly on the things you love, guilt-free. The most powerful concept in the book is automation. Ramit shows you how to build a financial machine that runs in the background so you don't have to rely on willpower, which is a finite resource. Imagine setting up a series of automatic transfers on payday. Before you even have a chance to spend it, a portion of your paycheck is automatically sent to your savings account. Another portion is automatically sent to your retirement investment account, like a 401k or an IRA. Another portion is sent to pay your fixed costs like rent and utilities. What's left in your checking account is what you can spend completely guilt-free on anything you want. This system flips the script. Instead of budgeting, which feels restrictive, you're consciously deciding where your money goes ahead of time. It's a conscious spending plan. This removes the daily stress and decision fatigue around money. You're no longer asking, "Can I afford this?" You already know the important stuff is taken care of. Your wealth is building on autopilot. Ramit's book is the bridge between the simple habit of saving and the world of actual investing. He demystifies concepts like asset allocation and index funds in a way that is incredibly accessible. He doesn't just tell you to invest, he tells you exactly which types of low-cost accounts to open and what kinds of funds to look for. It's like having a financial coach hold your hand and set up your entire system for you. For anyone who feels overwhelmed by the sheer number of choices in modern finance, this book is a godsend. It cuts through the noise and gives you a clear, actionable plan. At number 5, we're taking a significant step up in terms of economic theory, but it's presented in a way that anyone can understand. The book is A Random Walk Down Wall Street by Burton Malkiel. First published in 1973, this book has been updated many times and remains one of the most comprehensive and respected guides to the investment world. If the previous books built your financial house, this one gives you a complete tour of the entire neighborhood, explaining how everything works. Malkiel's central and somewhat controversial idea is the efficient market hypothesis. Now, don't let the technical names scare you. The concept is actually pretty simple. Imagine a giant, global flea market where millions of incredibly smart, well-informed people are all buying and selling the same things, stocks. Because everyone has access to the same public information, the prices of those stocks almost instantly reflect all the available knowledge and expectations. What this means, Malkiel argues, is that trying to consistently find undervalued stocks is incredibly difficult. Almost like trying to find a $20 bill lying on the ground in Grand Central Station. Someone has probably already seen it and picked it up. Therefore, he concludes, a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. This isn't to say that experts are useless, but that the costs they charge for their expertise often eat up any extra returns they might generate. So what's the solution for the average person? Malkiel was one of the earliest and most powerful advocates for what we now call the index fund. Instead of trying to pick the winning stocks, you simply buy a fund that holds a little bit of every stock in a major market index, like the S&P 500. By buying an S&P 500 index fund, you're not betting on Apple or Google specifically. You're betting on the long-term growth and innovation of the entire American economy. You own a tiny slice of 500 of the largest companies in the country. This strategy guarantees you'll capture the market's overall return, and because it's a passive strategy, the management fees are incredibly low. Malkiel provides decades of data showing that this simple, boring strategy consistently outperforms the vast majority of highly paid, active fund managers over the long run. Reading this book is like taking a full semester course in finance. It covers stocks, bonds, real estate, and even bubbles like the tulip mania and the dot-com crash. It gives you the historical context and the theoretical framework to understand why a simple, low-cost, diversified approach is the most sensible path for most investors. Now we arrive at number 4. And this one is a modern classic that shifts our focus from the mechanics of the market to the most chaotic and unpredictable variable of all, ourselves. The book is The Psychology of Money by Morgan Housel. Housel's argument is brilliant and profound. Doing well with money has a little to do with how smart you are and a lot to do with how you behave. Financial success is not a hard science. It's a soft skill where psychology is more important than spreadsheets. He illustrates this with 19 short stories, each highlighting a specific quirk of human behavior related to money. One of the most powerful ideas is the difference between being rich and being wealthy. Being rich is about your current income. You see a doctor with a high salary driving a fancy car? That's rich. It's visible. But wealth, Housel argues, is what you don't see. It's the income not spent. It's the car not bought, the watch not worn. Wealth is the money in your savings and investment accounts that is compounding quietly, giving you options and freedom. This is a critical distinction. We see people's lavish spending, and we try to emulate it, thinking that's the path to financial success. But true wealth is hidden. It's the financial flexibility to be able to change careers, handle an emergency, or retire on your own terms. It's about having control over your time, which Housel calls the ultimate dividend that money can pay. Another key concept is understanding your own relationship with risk and time. Housel points out that the stock market's long-term returns are incredible, but they don't come for free. The price of admission is volatility and uncertainty. You have to be willing to endure the scary downturns without panicking and selling at the bottom. The ability to remain invested during periods of fear is not an analytical skill, it's a psychological one. It's about being able to stomach the ride. Think about it like this. A professional surfer knows everything about wave dynamics, but what makes them great is their ability to stay calm and balanced when a giant wave is about to crash on them. Most amateur investors know they should buy low and sell high. But when the market crashes, their fear takes over and they do the exact opposite. The Psychology of Money teaches you to be that surfer, to understand that volatility is just the fee you pay for great long-term returns, and that your behavior during those turbulent times will determine your success more than any stock-picking strategy ever could. This book is less of a how-to guide and more of a how-to-think guide. It will fundamentally change your relationship with money and help you avoid the behavioral mistakes that sabotage most investors. We're now in the top 3, and at number 3, we have a book that will make you feel empowered. It's One Up on Wall Street by Peter Lynch. Lynch was the legendary manager of the Fidelity Magellan Fund, which he grew from $20 million to over $14 billion in 13 years, achieving an average annual return of over 29%. And his core message is that the average person has advantages that the Wall Street pros don't. Lynch's idea is simple: invest in what you know. He argues that your personal and professional life gives you a unique edge. You might work in a specific industry, have a particular hobby, or just be an observant consumer. In your daily life, you encounter companies and products long before they become Wall Street darlings. This is what he calls local knowledge. Let's use an example. Imagine it's the early 1980s. You're a frequent traveler, and you notice a new regional airline called Southwest. Their planes are always full, their staff seems happy, and their prices are unbeatable. You talk to friends in other cities, and they're all buzzing about it. At this point, Southwest is still a small company, largely ignored by the big analysts in New York. But you, the average person, have an on-the-ground insight. You've identified a potentially great company. Lynch says this is the starting point. It's not enough to just like the product. He then lays out a framework for doing the follow-up research. You have to check the company's financial health, understand its story, and figure out if it's a stalwart, a cyclical, a fast grower, or another one of his famous categories. He provides a non-technical, common-sense guide to reading a balance sheet and understanding what makes a business successful. The book is famous for popularizing the term 10-bagger, which is an investment that goes up 10 times its original value. Lynch found many of these by following his own advice. He noticed his wife loved a new brand of pantyhose called Legs, which were sold in grocery stores. He investigated the parent company, Hanes, and made a fortune for his fund. He saw Taco Bell expanding everywhere and invested before it was a national giant. One up on Wall Street is the ultimate antidote to feeling like you're just a small fish in a big pond. It's incredibly optimistic and empowering. It tells you that you don't need a PhD in finance to succeed. You just need to be curious, do your homework, and pay attention to the world around you. It turns a trip to the mall or a conversation with a colleague into a potential investment research opportunity. It's a call to arms for the amateur investor, showing you how to use your unique perspective to potentially beat the pros at their own game. Our runner-up at number 2 is a book that is less of a story and more of a powerful, data-driven manifesto. It's The Little Book of Common Sense Investing by John C. Bogle. Bogle was the founder of the Vanguard Group and the creator of the very first index fund available to the public. If Burton Malkiel academically proposed the idea of index investing, John Bogle was the revolutionary who put it into practice and championed it for a lifetime. This book is the culmination of his life's work. Bogle's argument is brutally simple and devastatingly effective. Investing is a zero-sum game before costs. For every buyer, there is a seller. For every investor who beats the market, another must lose to the market. As a group, all investors in aggregate earn the market's return. We have to subtract the costs of playing the game: brokerage commissions, mutual fund expense ratios, advisor fees, and taxes. After you subtract all these costs, the average investor's return must, by mathematical certainty, be less than the market's return. He calls this the relentless rules of humble arithmetic. The real enemy of the investor is not a bear market. It's the tyranny of compounding costs. Imagine you have two funds that both earn a gross return of 7% per year. One is a high-cost, actively managed fund that charges a 2% expense ratio. The other is a low-cost index fund that charges just 0.04%. That difference seems small, right? But over 40 years, a high-cost fund will have consumed more than half of your potential returns. The costs compound just as relentlessly as your earnings. Bogle's solution is radical in its simplicity. Own the entire stock market through a low-cost, broad market index fund and hold it forever. Don't look for the needle in the haystack. Just buy the whole haystack. This strategy eliminates the guesswork of picking stocks, the futility of trying to time the market, and, most importantly, it minimizes the costs that drain your wealth over time. This book is not about finding exciting new companies. It's about a philosophy of winning by not losing. It's about accepting that the most effective strategy is often the simplest and most boring one. Bogle uses chart after chart, table after table, to prove his point beyond any reasonable doubt. He methodically dismantles the arguments for active management, showing how the vast majority of fund managers fail to beat their benchmark index over the long term. especially after their fees are taken into account. Reading this book feels like having the wisest, most honest grandfather in finance sit you down and tell you the unvarnished truth. It's the definitive guide to passive investing from the man who invented it. And now, we arrive at number 1, the book that Warren Buffett has called by far the best book on investing ever written. A book so foundational, so profound, that its principles have guided the most successful investors for over 70 years. The greatest investing book of all time is The Intelligent Investor by Benjamin Graham. First published in 1949. This is not an easy read. It is dense, it is detailed, and it requires concentration. But the wisdom contained within its pages is priceless. Graham was a professor at Columbia Business School and the mentor to a young Warren Buffett. He is universally known as the father of value investing. And in this book, he lays out the 2 concepts that are the bedrock of this philosophy: Mr. Market and the margin of safety. Let's start with Mr. Market. This is perhaps the most brilliant metaphor in the history of finance. Graham asks you to imagine that you own a small share in a private business, and you have a business partner named Mr. Market. Every single day, without fail, Mr. Market shows up and offers to either buy your share from you or sell you his share. The catch is that Mr. Market is a manic depressive. Some days, he is euphoric about the business's prospects and offers you a ridiculously high price for your share. On other days, he is in a deep, dark panic and, convinced the business is doomed, offers to sell you his share for pennies on the dollar. The intelligent investor, Graham says, is free to either ignore Mr. Market completely or to take advantage of him. You should be happy to sell to him when he's wildly optimistic and offers you a silly price. And you should be even happier to buy from him when he's hopelessly pessimistic and offers you a bargain. The mistake most people make is that they let Mr. Market buy them. Market's mood dictate their own. When the market is soaring, they feel euphoric and buy at high prices. When the market is crashing, they feel panicked and sell at low prices. Graham teaches us to treat the stock market not as a guide, but as a servant. Its purpose is to serve you, not to instruct you. The second core concept is the margin of safety. This is the central principle of value investing. Graham insists that you should never buy a security unless its price is significantly below its calculated intrinsic value. Intrinsic value is an estimate of a business's true underlying worth, based on its assets and earning power. The margin of safety is the difference between that intrinsic value and the price you pay. Think of it this way. An engineer designing a bridge calculates that it needs to support a maximum load of 10 tons. Do they build the bridge to hold exactly 10 tons? Of course not. They build it to hold 20 or 30 tons. That extra capacity is the margin of safety. It protects the bridge from unforeseen stresses, miscalculations, or just plain bad luck. In investing, the margin of safety does the same thing. If you calculate a company is worth $100 per share, you don't buy it at 98. You wait until Mr. Market, in one of his depressive fits, offers it to you for $50 or $60. That $40 or $50 gap is your margin of safety. It protects you from being wrong in your calculations and from the unpredictable misfortunes that can befall any business. The Intelligent Investor fundamentally reframes what investing is. It's not about speculating on squiggly lines on a chart. It is about becoming a part owner in a real business. Graham famously wrote, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative." This book provides the intellectual framework to be a true investor, not a speculator. It teaches you to be disciplined, patient, and to think for yourself. It's a dense and challenging book, but the effort it takes to understand it will pay dividends for the rest of your life. It's not just a book about investing. It's a book about developing a sound and resilient financial temperament. And that is why it stands alone at the top of our list.